We're jumping straight into Insight Molecular Diagnostics today. Everyone is watching the price action, but the real story is the strategic capital raise aimed at the FDA.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the nuts and bolts of this trade, do us a huge favor. If you want to simplify your market research, get these breakdowns delivered straight to you, just hit that subscribe button, smash the like, and let's get smarter together. All right, let's unpack this.
I think we need to start with a bit of a reality check here. We're looking at a ticker that has been, well, all over the place.
Oh, yeah.
Volatility is high. The market cap is pretty small compared to the giants in this sector. And frankly, unless you're a transplant surgeon, you probably never even heard of them.
True.
So let's just strip away the stock chart for a minute. What is the fundamental problem this company is actually trying to solve? How do they make money?
It all comes down to one terrifying word for patients: rejection, specifically kidney transplants. When a patient gets that new kidney, their immune system is constantly checking its ID card, and then it decides the new organ is a threat, it attacks.
And historically, the only way to know that attack was happening was, wait for the kidney to start failing? Or, I guess, jam a huge needle into it for a biopsy.
Exactly. Biopsies are invasive, they're painful, and they're reactive. They're a lagging indicator.
So you're finding out the house is on fire after the roof has already caved in?
That's it. The industry has been desperate for a leading indicator, and that is where the tech comes in. ddCFTNA.
Okay, well, hold on. That is a serious alphabet soup. We have to break that down because the entire investment thesis really rests on that acronym.
For sure. It stands for donor-derived cell-free DNA. Think of it like cellular debris.
Okay.
When the body attacks that new kidney, cells in that organ die. They burst. And when they do, they spill their DNA into the patient's bloodstream. Insight's tech is designed to hunt for that specific foreign DNA.
So instead of a biopsy, it's just a simple blood draw.
Just a blood draw.
And if you see a spike in the donor's DNA floating around, rejection has started, maybe weeks before any real symptoms show up.
Precisely. It's a smoke detector instead of a pile of ash.
But this is where I have to play devil's advocate right away. Insight isn't the only one doing this right. You've got massive companies like Natera and CareDx.
The incumbents.
Yeah, they've been doing this for years. They have billions in market cap. So why does a small cap company think they can come in and eat the giant's lunch? What's the differentiator?
That is the multi-million-dollar question. And the answer isn't just about what they test. It's about where they test.
Okay.
The giants, Natera, CareDx, they operate on a centralized lab model.
Meaning the hospital draws the blood, puts it in a FedEx box, ships it off to some huge facility in California or Texas, and then waits 3, maybe 5 days for a result.
That's the one. It's the mainframe era of computing. It's slow, it's logistically a nightmare, and it's expensive. Insight is trying to bring in the PC era.
The decentralized model.
They're pivoting the whole industry to it. They don't want to be the lab. They want to sell the GraftAssure kits so the hospital can run the test itself in-house.
I see. So to use an analogy, the competitors are like that old school photo lab where you'd mail in your film and wait a week.
Yeah, exactly.
And Insight is selling the high-end photo printer that sits on your desk.
That's a good way to picture it, yeah. But let's look at it financially, because this is where the disruption really happens. Think about the hospital's CFO.
The person counting the beans.
Right. In the current model, the hospital sends a sample to, say, Natera. Natera bills the insurance company. Natera keeps all that profit. The hospital just did the blood draw, which pays, peanuts.
So a hospital is just a cost center in that whole equation, a pass-through.
Or pass-through, exactly. But if the hospital runs the Insight kit in-house, the hospital runs the test, the hospital bills the insurance. The hospital keeps that reimbursement revenue.
And Insight just sells them the razor blades, the kits.
Bingo. You are turning a cost center into a profit center. And in a world where hospital margins are razor thin, that's a massive, massive incentive to switch.
Okay, that makes total sense economically, but scientifically, if it's that lucrative, why hasn't Natera just launched their own kit? Why hasn't the 800-pound gorilla just crushed them?
Because they literally can't. It
Yeah.
comes down to the underlying tech stack. The giants use something called NGS next-generation sequencing.
Right.
It's incredibly powerful technology, don't get me wrong, but it's like using a supercomputer to do simple math.
It requires huge machines, climate-controlled rooms, teams of PhDs just to run the thing.
Exactly. It doesn't scale down. You can't just put an NGS workflow in a standard hospital lab in the basement. It's too complex, too expensive. Insight, on the other hand, built their IP around digital PCR.
Digital PCR.
Yeah.
So how is that different from the supercomputer approach?
Okay, imagine you're looking for a specific typo in a massive library of books. NGS, it reads every single book page by page to find that one error. It takes a ton of time and processing power.
Right. Got it.
Digital PCR is more like using Control F on your computer. It ignores all the background noise and just counts the specific molecules you're actually looking for.
So it's way more targeted.
It's targeted, it's faster, and crucially, the hardware is cheaper and smaller. That's their moat. They hold 10 patent families they got from a company called Chronix Biomedical, covering the US and Europe. This IP protects that specific method.
And sounds like that tech creates the stickiness we always look for in medtech.
And a massive stickiness. Think about it. Once a transplant center buys the machine, they validate it, they hook it up to their billing software, they train all their staff.
Yeah, they're not going back.
You think they want to go back to shipping FedEx boxes? No way. The switching costs are way too high. It creates a defensive wall. Once they're in, they're in.
Okay, so that's the bull case. You've got a disruptive model that makes hospitals money and proprietary tech that the competition can't easily copy.
That's the setup.
Which brings us to why we're talking about this today, the catalyst. February 11th, 2026, a $26 million share offering.
This is the pivot point. Now, usually, when a company prints more stock, the market just groans. It's dilution.
And the stock did take a hit at first. If you owned a slice of the pizza before that day, your slice just got smaller.
It did. But in biotech investing, you have to look at who bought the new slices and why. They sold about 4.5 million shares at $5.75 a share.
That price point, $5.75. Why is that so significant?
Because that's the price the smart money paid. Institutional investors, hedge funds, they don't just throw darts. They did their due diligence. By stepping in and buying millions of dollars of stock at $5.75, they're effectively drawing a line in the sand.
It sets a psychological floor.
Yeah.
They're basically saying, we believe the real value is higher than this.
Exactly. But the real question is, what is that money for?
Right. Are they just paying off debt, keeping the lights on?
No. This is offensive capital. This is a war chest. And it is specifically for R&D and, most critically, their FDA de novo submission for their main product, GraftAssure.
Okay, let's stop right there. De novo. We have to explain this because this segues perfectly into the risks. I feel like we've painted a very rosy picture so far. My job is to be the cynic. What does a de novo submission actually mean?
It's the difference between walking a paved path and hacking through a jungle with a machete. Most medical devices try to get through on what's called a 510K application.
Where you just prove you're similar to something that already exists. We're just like Product X, so approve us.
Exactly. But de novo means there is no predicate. You're telling the FDA, this is new. We are the first ones doing this specific way.
Which means the scrutiny is way higher, the timeline is longer, and the chance of rejection is significantly higher.
Correct. You're the guinea pig. And that leads us straight into the bear case. We have to be realistic here.
Let's start with the burn rate. They just raised $26 million. In the grand scheme of FDA trials, is that actually enough to get them to the finish line?
That is the big risk. Clinical trials are incredibly expensive. You're recruiting patients, managing data, paying the sites. If the FDA comes back and says, this is good, but we need another 6 months of monitoring, that cash pile starts to look very small, very fast.
And if they run out of cash before they get approval?
They have to raise again, more dilution, probably at a lower price. That's the death spiral you want to avoid in small-cap biotech.
There's also the issue of, we'll call the black box. I was looking through the summaries, and it's pretty hard to pin down their exact financial health right now.
You noticed that too, huh?
I did. We know they raised money, but what about specific revenue figures? Profit margins? It's all a bit opaque.
That's a classic sign of an early commercial stage company. They're not focused on optimizing profit yet. They're focused on survival and growth.
But that's a risk for an investor. There's no clear line of sight on profitability. There's no dividend to pay you while you wait. No buyback program to prop up the price.
It's a pure growth play. You're buying a promise, not a paycheck.
And we can't ignore the competition. We talked about Natera. These aren't just companies. They are institutions. They have armies of sales reps, established relationships with thousands of doctors.
This is the operational risk, the behavioral moat. Even if Insight has better tech and better economics, you still have to convince a transplant surgeon, who is one of the busiest, most stressed people on the planet, to change their entire workflow.
If it ain't broke, don't fix it.
Exactly. You're asking them to stop doing what's worked for 10 years, sending a box to Natera and trust some new box in the basement. That's a huge behavioral hurdle. And Natera isn't going to just roll over. They will fight on price. They'll fight on service.
So on one hand, you have this disruptive tech and a decentralized model that makes a ton of sense. On the other, dilution, financial opacity, and a massive regulatory hurdle.
That is the battlefield. So the question for you listening is, what do you watch for? If you're looking at this trade, what are the signals?
Right. We need triggers. What are we looking for in the next 30 to 60 days?
First and foremost, cash deployment. The deal closed around February 13th. We need to see them spending that money on the right things immediately.
You mean like checking for job postings?
Exactly. Go to their LinkedIn. Are they hiring clinical trial managers, regulatory affairs specialists? If they're hiring more marketing fluff, that's a red flag. We want to see the money going into that FDA pipeline.
Okay, so watch the spend. What else?
Regulatory milestones. In a de novo process, there are checkpoints. Look for press releases about Q-sub meetings or any kind of FDA feedback.
Q-sub. That's the pre-submission meeting.
Yes. And even a boring, generic press release saying, meeting concluded successfully, is a massive de-risking event. It means the FDA isn't shutting the door, the conversation is happening.
And the data itself, the tech has to work.
That's the third trigger, conferences. Keep an eye on the major immunogenetics and transplant meetings. They have a research-use-only version called GraftAssure IQ.
That's the one they can sell to researchers right now before the full FDA approval.
Correct. And researchers love to publish. If you see a poster presentation or a paper showing that GraftAssure IQ detected rejection 3 weeks before a biopsy could, that's your proof of life. Positive data is the ultimate fuel for a stock like this.
And finally, let's zoom out. Does the macro environment matter here?
It always matters. Watch the sector rotation. We're in a rate environment where growth biotech is super sensitive.
Because when interest rates are high, future profits that might be 5 years away, are just worth less today.
Exactly. But if REITs stabilize or drop, money floods back into these risky pre-profit companies. It's a risk-on environment.
Rising tide lifts all boats.
Precisely. If the XBI, the biotech ETF, is ripping, Insight will probably outperform. If the sector is dumping, Insight will probably get crushed harder. It's a high beta play.
Okay, let's bring it all home. We've covered the tech, the decentralized model, the $5.75 mark money floor, and all the risks. Summarize the trade.
Here's the lowdown. You are looking at a classic disruption play. Insight Molecular Diagnostics is betting that the future of medicine is local, not centralized.
And they're betting $26 million on it.
The risk-reward setup is clear. You have the chance to buy in right alongside institutional heavyweights at that $5.75 level. If they execute, if they get that FDA stamp of approval, the market for this is billions of dollars. This could be a multi-bagger. But if they fail, if the FDA says no, or if they run out of cash before they get there, it is the long, long drop.
It's binary.
It is. It's a classic show-me story. The patents are there. The cash is now in the bank. The team is in place. Now they just have to execute. They have to prove they can do it.
Well, it is certainly one to keep on the watch list. It's rare you see such a clear-cut battle between a new business model and an old monopoly.
Absolutely. And that is why we track it.
Thanks for tuning in to The Easy Money Show. We hope this cleared up some of the noise around the ticker for you.
Make sure you're subscribed so you don't miss our next breakdown. We'll see you next time.